Are you overwhelmed by 3,000 ETFs? Imagine if one single fund could beat them all, hands down. Right now, 90% of do-it-yourself investors underperform the market, but you don't have to be one of them. No more costly trial and error. Today, I will show you the one simple ETF that can flip those odds in your favor. And by the end of this video, you will know the exact ETF I would hold for life. So here's our roadmap for the next 8 minutes. Number 1, why niche ETFs can blow up your plan. Number 2, why broad index funds let you sleep at night. Number 3, dividend versus growth. Pick your fuel. Number 4, my number 1 forever pick. And number 5, a bonus dividend hack that boosts any S&P 500 fund, no extra fees, no extra work. I'm Maurice and I'm in the financial industry for over 15 years now, where I've managed portfolios with over $30 million. I have seen investors trip over complex strategies, fall into the same traps, and I used to do the same. So let's dive in. Number 1, why niche ETFs can blow up your plan. These ETFs feel like insider secrets, biotech breakthroughs, AI rocket software, clean energy. But one wrong headline can wipe out 30% or more in days. It's really volatile, trust me. My wake-up call was in 2018. I owned a tech-only ETF loaded with the hottest stocks. And a single earnings miss by a major company erased 35% of that fund in just 1 week. And I panicked. Sold at the absolute bottom, locked in a massive loss. That pain brought me 2 brutal truths. High concentration is high risk. You are betting on a handful of companies, one stumble, and your portfolio takes a nosedive. Emotions wreck your return. Fear and greed make you buy high and sell low. If your goal is to buy and hold forever, you don't need extra roller coaster rides. You need calm seas, not rough waves. And that's exactly why you need an ETF built for stability. One that spreads risk across hundreds of companies and smooths out the ups and the downs. Number 2, why broad index funds let you sleep at night. Enter broad index ETFs. The S&P 500 is the classic, but there's also the total market ETFs, international ETFs and more. So what makes them safe? 1, diversification. One ticker owns hundreds of companies across every major sector. Tech, health, finance, consumer staples, energy, and of course more. Number 2, built-in ballast. When one industry stumbles, the other keep you afloat. Oil dips, tech holds, retail slows, healthcare picks up the slack. Number 3, historically steady. Over the past 65 years, the S&P 500 has returned about 10% per year on average, including the crashes of 2000, 2008 and 2020. And this is why this is so important, that consistency matters. You won't get 50% gains in one single year, but you won't lose 40% either. You get gentle hills and valleys instead of gut-wrenching drops. And a quick fact, in 2008 the S&P 500 fell 38%, the largest single drop in a year, since the index inception of 1957. The very next year, in 2009, it rebounded 23% and 26% when you include dividends. Those are swings, but nothing like a sector ETF that can drop 50% and take a decade to recover. Now that you see how broad diversification tames the biggest market swings, the next decision is choosing your engine. Imagine your ETF as an engine. One runs on steady cash and the other one on high octane growth. Dividend ETFs like SEHD or the VIG are your cash machines. Every quarter they deposit real money into your bank account. Checks you can reinvest automatically to buy more shares. That dividend stream cushions your ride. When prices dip, the payouts keep coming, offsetting losses and smoothing out the ride. Since SEHD launched, it's averaged over 30% annually, half of which comes from those reliable dividend checks. On the other hand, growth ETFs like QQQ or SEHG hunt tomorrow's superstars. One breakout stock can fuel a 50% gain in a year, but it can just as easily crater 30 or 40% in a single quarter. Those wild swings test your nerves and hit your returns if you panic sell. So which engine do you want? A consistent cash generator that tames volatility, or a rocket ship that can blast off with the risk of turbulence? In a true buy and hold forever strategy, that dependable dividend engine often wins the stress test, while still delivering solid growth. Which one do you have to choose? If you need income or want a smoother returns, dividends win. If you can stomach big swings and chase maximum upside, growth might excite you. For a single lifetime ETF, I lean on dividends, or at least on broad exposure that includes dividends. Number 4, my number one forever pick. After all the research, the number one can go wrong ETF for a one and done strategy is the VOO, the Vanguard S&P 500 ETF. So why the VOO? Number 1, massive diversification. 500 blue chip US companies across every sector. You have a proven track record of 10% annualized returns since 1957 through 6 recessions. You have ultra low fees, expense ratios is only 0.03%, and over 30 years that tiny fee difference can save you tens of thousands of dollars. Tax efficiencies. Vanguard's structure minimizes capital gains distributions, so you keep more of your money. Easy trading and highly liquid. Tens of millions of shares trade daily, so you never have to worry about wide bid-ask spreads. And if you want a quick comparison, the SPI, the biggest S&P 500 ETF, has a 0.09% fee. That extra 0.06% costs you about $600 per $100,000 invested per year. And over decades, those fees compound against you. So buy VOO. Forget it, reinvest the dividends, sleep easy, and over the next 10, 20, 30 years, that simple decision does the heavy lifting for you. And then number 5, the bonus hack. Turbocharge your S&P 500. Here's a quick trick to get some extra performance without adding a second fund or paying more fees. Number 1, turn on dividend reinvestments. Most brokers offer this by a default setting. Number 2, set up monthly auto buys. Instead of waiting quarterly, you spread your purchases across 12 entry points per year instead of 4. Number 3, add small regular contributions. Even a $50 a month compounds dramatically over time. So why does this work? Dollar cost averaging. You buy more shares when prices dip and fewer when they rise. Smoother returns. Monthly buys capture more price points, reducing the impact of big swings. Compounded growth. Those small frequent investments snowball over decades. No fancy strategies, no extra ETFs, just automation and patience. Let's say you put in just $50 every month for 30 years. That's $18,000 of your own money. But if you would invest that money with a 10% interest rate, your money would grow to a $130,000. So what's that one ETF you have chosen or maybe plan to buy for your forever portfolio? Drop the ticker and why in the comments below. But before we end this video, here's one problem. Even with a rock solid ETF and a 10% return, most investors trip over 5 deadly mistakes. And I see this time and time again with my clients. And those simple slip-ups are exactly why so many never reach early retirement. So in this video, Jack Bogle shares the 5 biggest investment mistakes so you can overcome them and finally hit your goals. See you in the next video.